Listen to me very carefully, because I am not going to repeat myself, and I'm not going to waste your time with pleasantries. Right now, as you are sitting there watching this video, the financial system is undergoing one of the most significant transformations it has seen in decades, and the overwhelming majority of investors, people just like you, have absolutely no idea what is happening beneath the surface. Gold and silver are not just moving. They are sending you a message, a loud, unambiguous, mathematically precise message about where this economy is headed, about what the Federal Reserve is actually doing versus what it is telling you, and about whether the dollars sitting in your savings account are going to hold their value or evaporate quietly while you sleep. I have spent my career turning ordinary people into serious investors. But I will tell you right now with complete honesty, the window for what I'm about to describe to you is narrow. It is closing, and if you miss it, you will spend the next 5 years explaining to yourself exactly why you waited. If you're watching this channel for the first time, I need you to do one thing before we go any further. Hit that subscribe button right now. The information I'm about to lay out for you in the next 25 minutes is the kind of market intelligence that institutional investors pay research teams hundreds of thousands of dollars per year to compile. You are getting it here, in plain language, completely free. But only if you are subscribed. Hit the button, turn on the bell notification, and then pay attention, because what comes next could genuinely change the financial trajectory of your life. Now, let us talk about what the Federal Reserve is actually doing, because there is a profound and dangerous gap between what the Fed says publicly and what the numbers are telling us in cold, hard reality. The Fed talks about interest rates as though they exist in isolation, as though raising or holding rates at a certain level is a complete and sufficient description of monetary policy. But that framing is deliberately incomplete, and whether it is intentionally misleading or simply incompetent, the result for the average investor is the same. You get hurt. The number that actually matters, the only number that has ever mattered in the history of monetary economics, is the real interest rate, not the nominal rate that Jerome Powell reads off a teleprompter. The real rate. And the real interest rate is calculated by taking the nominal rate and subtracting the actual rate of inflation. That is it. That is the entire formula, and it is the formula that determines whether gold goes up or down over any meaningful time horizon. Here's where it gets dangerous for anyone who is not paying attention. Right now, even as the Fed holds rates steady or makes marginal adjustments of 25 or 50 basis points in either direction, the inflation rate in this economy is rising. It is rising because of oil prices, because of food prices, because of the cascading commodity pressures that flow from a prolonged geopolitical conflict in the Middle East. It is rising because of the monetary policy decisions that were made years ago, decisions whose consequences are still working their way through the system like a slow-moving flood. When you take a nominal interest rate that is barely moving and subtract from it an inflation rate that is accelerating upward, you get a real interest rate that is collapsing. And a collapsing real interest rate is the single most historically reliable fuel for a sustained bull market in gold. This is not my opinion. This is not a prediction. This is arithmetic. Goldman Sachs, one of the most well-resourced research operations on the planet, has maintained their 2026 year-end price target for gold at $5,400. And they are basing that on exactly this dynamic. Continued central bank buying, combined with the expectation that the Fed will ultimately be forced to cut rates by at least 50 basis points. But here is what Goldman is not telling you loudly enough. Even without those rate cuts, even if the Fed does absolutely nothing, the real rate environment in 2026 is going to be dramatically more favorable for gold than anyone projected at the start of this year. The math does not care about what the Fed intended. The math only cares about what the numbers actually are. Now, let us talk about gold and silver specifically, because I want you to understand what happened in March and why it was one of the most significant mispricings I have seen in a commodity market in a very long time. Gold had its worst monthly performance since 2008 in March of this year. Let that sink in. The metal sold off hard. And when you first hear that, if you are an unsophisticated investor, your instinct is to think that something is wrong with gold, that the story has changed, that maybe gold is not the safe haven it was supposed to be. That instinct is exactly wrong, and acting on it will cost you money. Here is what actually happened in March. Global investors facing sudden and severe losses across equity markets in response to the conflict in Iran. They needed cash. And because gold had already delivered extraordinary gains throughout 2025, the best year for gold since 1979, it represented one of the only positions that most institutional portfolios were still sitting on, a profit in. So they sold gold, not because gold was wrong, not because the thesis had changed, not because inflation was going away or the Fed was suddenly going to raise rates dramatically. They sold gold because it was the one thing they could sell without locking in a catastrophic loss. That is a liquidity-driven sell-off. And liquidity-driven sell-offs in fundamentally sound assets do not represent a change in direction. They represent a buying opportunity of historic proportions. Gold entered 2026 already up 8.3% through the first quarter despite that brutal March sell-off. And now look at what happened in the very first week after that bottom. Gold went from approximately $4,100 on Monday morning, which should not have happened, which was a price that made no fundamental sense given the inflation environment, the geopolitical environment, and the monetary policy environment, all the way up to nearly $4,800 by Thursday, representing a gain of approximately 17% in a matter of days. It closed the week at $4,676, still representing a weekly gain of 5.8%. Silver moved right alongside it, closing back above $70 at $72.90, up 7.2% on the week. These are not small numbers. These are not the kind of moves that happen in markets that are running out of steam. These are the kinds of moves that happen at the beginning of a major repricing event. And if you understand what is driving them, the real rate collapse, the de-dollarization trend, the budget deficit expansion, the commodity inflation cascade, then you understand that these moves are not the end of something, they are the beginning. Let me turn your attention to mining stocks, because this is where the real asymmetric opportunity lives right now. And I say that as someone who has built an entire career around finding situations where the market is deeply structurally mispricing an asset relative to its fundamentals. The GDX, which tracks large cap gold and silver mining companies, was up 14.5% in a single week. The GDXJ, which tracks the junior miners, was up 14.8% in that same week. Those numbers sound extraordinary, and they are. But here's the critical context that most people are missing entirely. Even after those gains, even after nearly a 15% surge in 1 week, gold and silver mining stocks remain dramatically below their highs from the end of February. And let me be very direct with you about what that means. It means the market has not yet fully priced in the move in gold and silver. It means that mining stocks, which derive their profitability directly from the margin between what it costs them to pull metal out of the ground and what the market pays them for that metal, are trading as though gold is still at levels it was at months ago. That is a mispricing. That is the market failing to do basic arithmetic. And those situations do not last forever. Yes, oil prices are higher right now. And yes, higher oil prices do put some pressure on mining operations because energy is a real input cost for mining companies. But the magnitude of that pressure is nowhere near sufficient to offset the enormous gain in the value of the product those miners are producing. When gold goes from $3,000 to $4,700, the incremental cost of energy does not even come close to eating that margin. The math is simple, and the market will eventually be forced to acknowledge it. The question is whether you are positioned before that acknowledgement happens or after. The people who bought GDX and GDXJ at the lows of last week made 14% to 15% in 4 trading days. The people who waited for confirmation, who waited for the headline to say mining stock surge, bought at the top of that initial move, and are now waiting for the next leg. You cannot be the person who is always one step behind the trade. You have to do the work, understand the fundamentals, and be positioned before the move happens, not after it. Now, I need to talk to you about something that most financial commentators are either too diplomatic or too financially compromised to say out loud, and that is the accelerating death of the US dollar as the world's reserve currency. This is not a fringe theory. This is not conspiracy thinking. This is a geopolitical and economic process that is already underway, that is measurable, and that has direct, calculable consequences for the price of gold and silver over the next several years. And look at what is happening right now with the Iran conflict and America's response to it. The United States went in, conducted its military operations, and is now signaling to the rest of the world, to the UK, to France, to Germany, to every country that depends on oil flowing through the Strait of Hormuz, that it is essentially their problem now that America has its own oil, is energy independent, accomplished its strategic objectives, and the rest of the world can figure out the maritime and energy security situation on its own. Now, I am not here to make a geopolitical judgment about whether that posture is right or wrong from a policy standpoint. What I'm here to tell you is what that posture does to America's standing in the global financial system. And the answer is that it damages it significantly For decades, the US dollar has maintained its reserve currency status not simply because America is economically powerful, but because the rest of the world trusted that America would be a reliable steward of the global financial and security architecture. Other nations have financed America's trade deficits and budget deficits, effectively lending America money at favorable terms because they believed in that reliability. When that reliability is called into question, when America is seen as an actor that will conduct military operations that create enormous regional instability and then simply walk away from the consequences, the willingness of other nations to continue financing America's deficits weakens. And when that willingness weakens, the demand for US dollars weakens, and when demand for dollars weakens while the supply of dollars continues to expand to deficit spending and monetary policy, the dollar falls. And when the dollar falls, gold rises. This is not complicated. De-dollarization is already happening. Central banks around the world have been buying gold at record rates precisely because they are reducing their exposure to US dollar-denominated assets. That trend is going to accelerate, not decelerate, given the current geopolitical dynamics, and it is one of the most powerful long-term structural tailwinds that gold has ever had behind it. There is also the matter of America's potential withdrawal from institutions like NATO, which, regardless of whether you believe NATO serves a valid purpose, represents yet another signal to the world that the United States is retreating from its role as the guarantor of global stability. Every time that signal is sent, the dollar's reserve status erodes a little bit more, and every point of erosion is a point of support for gold priced in those dollars. I want to spend time on inflation now, because I think most of you are fundamentally underestimating what is coming, and if you underestimate it, you will be underpositioned. And being underpositioned in an inflationary environment is one of the most effective ways to destroy real wealth that exists. Let us start with oil. Oil prices are elevated right now because of the Iran conflict, and there's a widespread assumption in the market, one, that is being encouraged by certain politicians, that as soon as the conflict ends, oil prices will collapse back to pre-war levels. I am telling you that assumption is wrong, and here is why. The conflict in the Middle East has caused physical damage to infrastructure, has disrupted shipping routes, has created uncertainty that will take years to fully resolve in terms of investment flows into energy production in that region. Even when a ceasefire is declared, even when a peace agreement is signed, the underlying infrastructure damage, the insurance costs, the risk premiums that energy traders will demand for that region, all of that persists. Oil is going to be higher for longer than the market expects. Not forever, but for years and years. It will be structurally elevated above where it would have been absent this conflict. Now take that oil price and run it through the rest of the economy. Higher oil means higher transportation costs, which means higher costs for every physical good that is shipped anywhere. Higher oil means higher fertilizer costs, because fertilizer production is deeply energy intensive, which means higher food prices. And we're already seeing that in coffee prices, in grain prices, in the cost of virtually every agricultural commodity. These are not temporary blips. These are structural price increases that are going to feed into the consumer price index month after month, quarter after quarter. And as the CPI rises, even in the way the government measures it, which almost everyone with an economics background understands, systematically understates actual experienced inflation, real interest rates fall further and further. The 10-year Treasury yield ended the week at roughly 4.31%, the 30-year at 4.89%. Those are not low yields in nominal terms, but when you compare them to an inflation rate that is climbing and will continue to climb, they represent deeply negative real rates. And deeply negative real rates are the environment in which gold does not just go up. Gold goes up dramatically, sustained, and with broad participation from investors who were previously sitting on the sidelines. There is also the fiscal dimension to this that I want you to understand clearly. The war has increased budget deficits. Wars always do. And increased budget deficits have to be financed. They are financed by issuing more treasury bonds, which puts upward pressure on yields, which in turn puts upward pressure on mortgage rates and borrowing costs throughout the economy, which slows consumer spending, which weakens economic growth. So you end up in a situation where the economy is weakening at the same time that inflation is rising. And the precise definition of stagflation, and stagflation, according to historical research, going back to 1973, is one of the most favorable environments for gold that exists. Gold carries no counterparty risk. It does not default. It does not get diluted by a printing press. In an environment where paper assets are being simultaneously threatened by both economic weakness and currency debasement, Gold is not just a good investment, it is the logical, mathematically supported conclusion that any serious investor should reach. There is going to be enormous political pressure to introduce economic stimulus before the midterm elections. That is not a prediction based on hope or cynicism. That is a prediction based on the basic mechanics of political survival. In a democratic system, when an economy is weakening, when unemployment is rising, when consumer sentiment is collapsing, elected officials look for tools to generate at least the appearance of economic activity before they face voters. And those tools inevitably involve spending money the government does not have, which means more deficit spending, which means more money creation, which means more inflation, which means more downward pressure on real interest rates, which means more upward pressure on gold. This cycle is self-reinforcing, and it does not stop until either the political will to break it emerges, which I see no evidence of, or until the market forces a reckoning. Right now, we are still in the phase of the cycle where gold is the asset that correctly reflects the reality of what is happening. The stock market, the bond market, the currency market, they are all still in the process of catching up to what gold figured out months ago. So here is where we stand. Gold closed the week at $4,676. It hit nearly $4,800 interweek before pulling back on disappointing political news, specifically the announcement that the conflict would continue to escalate rather than wind down. Silver is back above $70 at $72.90. Mining stocks, as represented by GDX and GDXJ, are up roughly 14–15% in a single week, but remain, in my professional assessment, deeply undervalued relative to the underlying metal prices. Goldman Sachs has a year-end target of $5,400 on gold. And I am telling you, based on everything I have laid out for you in this video, that $5,000 by the end of April is not a fantasy. It is a plausible, mathematically grounded scenario, given the pace of real rate compression, the acceleration of de-dollarization, and the structural inflation pressures that are building in this economy. The question is not whether gold and silver are going higher. The question is whether you are going to be on the right side of that move or the wrong side. Let me give you your final answer right now, and I want you to listen to every single word. You have two choices sitting in front of you. The first choice is to do nothing, to keep watching, to keep saying, I'll think about it, to keep waiting for the perfect entry point that never comes, to keep trusting that the same financial system that has been quietly destroying the purchasing power of your savings for decades is suddenly going to protect you. That is a choice, and it has consequences. And those consequences are measured in the real, compounding, mathematically inescapable erosion of your wealth over time. The second choice is to take what you have learned in this video, the real rate thesis, the de-dollarization trend, the mining stock mispricing, the inflation cascade, and act on it in a deliberate, sized, risk-appropriate way. That does not mean betting everything. It means allocating intelligently, understanding what you own and why you own it, and having the conviction to hold it when the market creates the kind of panic-driven volatility that shook out weak hands. In March, leave a comment below right now. Tell me where you stand. Are you already positioned in gold and silver, or have you been waiting? And if you found this video valuable, share it with one person in your life who needs to hear this, because the window is open right now, but windows do not stay open forever.